here we are. There we go. How's everybody doing this morning? What a wonderful day. Man alive, we've had some great weather down here in St. George. If you guys aren't down here and you're experiencing cold weather, just come down and visit. It's a beautiful, beautiful place. And we've had some great weather. So looking forward to having this class over so I can go outside and play in the warm weather today. All right. How's everybody doing? I haven't seen you in a little while. It's been a few days. And so I'm anxious and excited to get back and show you a few things. We're on 1 week break from the university. So we taught all last week, had a fantastic class. And so this week we're off. And then next week we start up with our UBI course, Universal Basic Income course. So I'm very excited about that. So those of you who are not able to make it to St. George, look forward to next week. We're going to start back up into our Universal Basic Income course. But right now I want to talk about some things that are action happening right now out in the stock market. So gold and silver, big plays lately. And they've been melting down, right? Melting down. So everybody's scared to trade gold right now. Everybody wanted in. Everybody is feeling FOMO, right? Fear of missing out. They wanted to buy in, but they were looking at those numbers and they're going straight to the moon. And they're like, I'm scared to buy that. I'm scared to buy that. So they didn't buy it, right? If you're like me, I didn't buy any. I went and put my money elsewhere because gold and silver were going too high. I was like, I can't buy it at those levels. And always justified some reason why I wouldn't buy any. I bought some silver. I bought some gold. I have a real physical, but I didn't go out and buy any in the markets. And so I put my money elsewhere. And now we got some opportunities, right? So let's go take a look at the gold and silver charts. But now everybody's like, I'm scared. I can't go. I can't go buy gold and silver now. It's flushing down. So everybody's scared to buy it when it's been a big rally, and everybody's scared to buy it on the dip, on the pullback. Maybe it's going to come back down way down here. Maybe it's going to come down here. I don't want to buy it now. It might flush all the way down here. It's been as low as right here. This is actually silver that we're looking at. And we remember back when we saw this and we're like, oh, that's where I should be buying silver. It's went up through this big, long uptrend, and now it's pulled back a little bit. I should buy some now. It went all the way up here, and then it flushed all the way back down to that exact same spot. So my son bought some physical silver right in here, and he's like, Dad, I rode that whole thing up with physical silver, and now it's all the way back down to where I bought it. I didn't make any money. This is a long-term play, buddy boy. Long-term play when you buy the physical. You're not out there buying and selling like you do when you do in the stock market or in the futures market. All right, this is the futures market right now. So we're actually looking at the price of silver in the futures market. And if we draw just a couple of little lines across here, you can see that this low right there, boom, came right down and touched this level right here. Now, I want to do something else for you. Watch this. We're going to take the Fibonacci numbers, and we're going to go just off of this low right down in here, all the way to the high right up in here. And look at this. This thing came down, and you guys who are still naysayers and don't think Fibonacci has anything to do with the stock market, look at that. You tell me if those people are not reading Fibonacci numbers. Of course they're reading Fibonacci numbers. You know why they're reading Fibonacci numbers? Because the big banks and hedge funds, they program those into their systems. They program those numbers in. And so they're not trading themselves, right? They're pushing the buttons to start the algorithms, and they do that kind of stuff. But they don't actually sit there like you and I do and click the mouse button. Hey, look at that. That's kind of, my mouse has a light on the bottom. All right, so they don't sit there and click the mouse button like that. All right, so that thing came right down to 61.8. Came right down here, right there, 61.8. Here's the Delta Kona probability. Just like that, right there. Okay, so that's your Delta Kona probability. And I'm going to show you, I know, everybody's like, we know what the Delta Kona probability is, Lan. You tell us all the time. But I'm going to pull it up and tell you again, because there's always new people in the class that never heard of this. And so I'm going to tell you what the Delta Kona probability is. So the Delta Kona probability just means that markets have a tendency. Look at this. I call it the Delta Kona probability. That's not its real name. If you go look it out on YouTube, you're going to have to look it up with the real name, which is 68, 95, 97 empirical data distribution rule. All right, that's the real name. If you search delta cone probability, it's going to come back, cannot find it unless it finds my stuff. I'm the only one that calls it that. But I call it that because it's based on options. We get the delta cone out of options, and so I just adopted it because it's too hard to say that. All right, so for your own research, make sure you use 68, 95, 99.7 empirical data distribution rule, and then you'll get all this information here. All right, so approximately 68.2% of market data stays within one standard deviation of the mean. That's right there, one standard deviation. All right, so this is your bell curve. Now, all I did is I took a normal bell curve that lays like this, and you see a bell curve like that, and I turned it sideways. Why did I turn it sideways? Because a market trades like this, right? It goes up and down like this. Markets don't go up like this. Well, they have in the last year, up like that. But they don't trade up, right? So they go sideways like this. So I turned the delta cone, turned it on its side, and said, look, if a market's going to trend, it's going to stay within that one standard deviation 68.2% of the time. And then around 95.4% of the time, it's going to come on, it's going to leave that one standard deviation, and it's going to go up to the second standard deviation. And then 99.7% of the time, it doesn't do this, but that last 0.3% of the time, it'll go up all the way into the third standard deviation. All right. And then there's the mean revision. So we come down to the next slide. And it says the mean revision says that once it gets up there to that 3 standard deviation, you have a high probability the market's going to come back down to that second standard deviation, back down to that third standard deviation. Now, it doesn't go down into the other side to the fourth standard deviation coming the other direction very often. Doesn't mean it can't, certainly can, sometimes does. Doesn't mean it can't go above 3 standard deviations to the upside, certainly can, sometimes does. Goes up 4 standard deviations, 5 standard deviations, 6 standard deviations away from the mean, all right? And what's the mean? It's from the low of the trend to the high of the trend. Okay, so that's your mean. And then, of course, we're going to look for 3 standard deviations. And we use tools to help us with that. So we can discover, and the tool I like to use for that the best is called bulls and bears. So we're going to come in here, chart overlay bulls and bears. And it's going to show you where your mean standard deviations are. So we're going to go from the bottom, and it started with one little standard deviation down in here, but we're going to go drive 1, drive 2, drive 3. All right, so that's your 3 standard deviations off of this bottom in here. Now, this first one was really kind of sucks. Not a very good one. Just a tiny little bounce in there. You almost don't want to count it. So you come in here, if you move that up, it doesn't make much difference. But that's the second drive and the third drive. So we call them drives. Drive 1, drive 2, drive 3. Okay, drive 1, drive 2, drive 3. Now, if you wanted to, you could come back here and you could go like this. Now, nobody knows what the exact ratios are, right? In hindsight, it's easy to see them, but as the market moves forward in time, it's not as easy. Let's go and look at, I want to go look at the S&P. Go look at the Dow, not the Dow, S&P. S&P. Pull up the mini S&P. And we're going to show you this one here. And we're going to turn on the bulls and bears chart overlay. We turn on the bulls and bears. And you can see the drives in here. See the standard deviations being measured? So as you come back farther and farther, you can see each standard deviation is one of these blue dots. So there's standard deviation 1, standard deviation 2, standard deviation 3, standard deviation 4. So it's making 4 drives up right before we get this big moon right here, this big fallback. And if we come back even farther, this market had this big old thing here. One great big old move. So that's 1 standard deviation, 2, 3, 4. See, as I told you, it doesn't often go past 3, but sometimes it'll even go, there's 3, 4, and then that little thing up there, 5. That almost makes you want to just put those 2 together. So 4 standard deviations, or you can just run those 3 together. 3 standard deviations, 1 standard, 2 standard, 3 standard deviations. That's what we're really looking for, is to where the top of that third standard deviation is. But then this one didn't even pop back down. So this market's just been on steroids, right? So it does the same thing going down the other side. But you're going to find that these markets do this a lot. So let's flip over to the stock market, and I'll show you some better examples of that cone of probability. Oh, stock market is right here. So let's actually, I got silver up. Let's go into Apple, and I'll show you perfect delta cone of probability. Look at this. Okay. So Apple started down here and we got the first breakout. Now, this is the accumulation stage right here. So we're going to call this just this big accumulation stage. All right. And then this one, look at this. Drive 1, drive 2, drive 3, drive 4. So see, it did go out. The 4 standard deviations doesn't usually do that. That's really rare. Usually we only get 3. Sometimes we only get 2. All right. And then you come with your Fibonacci ruler and you go from the bottom of the first start. You don't want to, you can go back way back here, but usually the computer systems are going to just measure it from here. And that's what we're really concerned about. We want to know where the big boys are putting their Fibonacci rulers. And they don't count the accumulation stage. They just count the drives. So because that's what they're really looking for. That's the drives, 3 drives, 1, 2, 3, and this went 4. And then it had 2 drives back down. So drive 1, counter trend, drive 2. And look where it came to on that Fibonacci number, came right back down into the delta cone of probability between 38.2, 61.8. And then this one touched 50% like a train on rails, just like that. Perfect. Okay. You're going to find that pattern everywhere because that's what it is. It's just the empirical data distribution rule. And we use Fibonacci rulers to kind of help us with that. But Fibonacci rulers, it's not just it's in fact most indicators are based on that same thing too. In fact, look at this. I'll come in here and see if I can grab that. Come on. This is also the same exact thing. All right, this is your MACD. Everybody's like, oh, I love MACD. MACD is the greatest. MACD is down here and it's turning green, and all that means I should buy. And we love MACD. You know what MACD is? It's the delta cone of probability. That's what it is. That's why we love MACD, right? Because it's the empirical data distribution center. So on a MACD, this line right here, this center right here, see that? The delta cone right there at the peak, that's your center line on the MACD. Okay. So the market is moving above the 1 standard deviation and it goes up. And how high up does it go? 1 standard deviations, 2 standard deviations, 3 standard deviations before it comes back down to the mean. And then it swings and goes low, 1 standard deviation, 2 standard deviations, 3 standard deviations, back up to the mean. That's what the MACD is. The MACD is measuring that delta cone of probability for you. And the very peak of that thing, say if you turn it sideways, makes more sense, doesn't it? You turn it sideways and then your bell curve, the very peak of your bell curve is that centerpiece right there. And so when the market goes up into those high delta cones of probability, they come right back down. And then they go down and swing to the lower delta cone of probability. And then they swing back up. That's all that thing's measuring right there. And that's why it's such a popular, good tool. There's others that do the same thing. We'll come in here. Let's show you. RSI. Everybody loves RSI. Oh, RSI is the neatest thing. We got to have the RSI. Let's go look at the RSI. Let's turn off MACD for a second. It's the same exact thing. The same exact thing. All right. Now I don't have the delta cone center in here, but we can put it in there. We come over here and we put this in here. We check one off and we put it in right at 50%. Okay, so now, and we'll make that 50%er, we'll make it bright magenta. How's that? Can you see it? All right, we're going to make those a little bit bigger. Oh, make that bigger. Okay, so we got nice bright magenta right here. See that? So that nice bright magenta, now that is your center line of the delta cone of probability. And you're like, oh, I love the RSI because when it gets up here in the overbought region, it's time to sell. When it gets down here in the oversold region, it's time to buy, right? Well, it's nothing more than just the delta cone of probability. That's all it is. It's measuring that exact same thing. Exact same thing. Okay? That's what it's doing. So now when you come in, you go, oh, I really love stochastics. Stochastics is the greatest thing since sliced bread. We got to have stochastics indicator. I love it. Well, turn off the RSI. And what do you have? You have a stochastics indicator with exactly the same damn thing. It's measuring the same thing. It's measuring the center. And then you have and you do that and you come in here and you make this 50%. And there's your, and we'll make it magenta just like the other one so we can see it. And there's your delta cone of probability again. Overbought, oversold, comes back down, goes back up, tells you your delta. Oh, but I love CCI. CCI is even better than all of them. Oh, you guys, you don't know anything without the CCI. What do you think CCI is? It's measuring the same damn thing. Delta cone of probability. these are all based on that theory. All these great indicators that everybody thinks is, oh, this is the magic bullet. Oh, this is the magic. Oh, I found the golden goose that lays the golden egg. What about something else? Let's see, RSI, SRSI, STO, ULTI, volume, no, volume. Let's see, Gator. Gator. Everybody's heard of Gator. Nobody's heard of Gator. But it's the same thing. Look, Gator, same thing. Center line. That's your delta cone of probability. That's all it is. All right, any more? ATR. See, ATR. ATR, that's not the same. That's not really, that's a little bit different. All right, let's go back to MACD though. We all love MACD. MACD is the most obvious one. Okay, so we'll turn on MACD, turn off ATR. So there's your MACD, and that's the delta cone of probability. So what we want to do is we want to kind of align those two up together. The actual market itself, where we're using, I like to use the bulls and bears because it turns the price bars red, yellow, and green. So green means that it's accelerating higher. Red means it's pulling back, right? Yellow is the neutral zone. So every smaller drive has a little delta cone of probability within it as well. So let's just take this Fibonacci ruler, and we'll just do this centerpiece right here, just these last two. So we'll come in here, we'll draw that one there, and we'll just go from one to the top of there. See that? So just the two drives. So drive one here, the pullback, and the drive two there. If you draw your little Fibonacci ruler over the top of that, you'll see that the market rallied up, came back down right here. Now, and the reason that's yellow is because it went into the Fibonacci sweet spot, what I call the Fibonacci sweet spot, or as you know it now, the one standard deviation right there. Okay, so that's what that is. That's why that price bars are yellow. And that's why I like the bulls and bears, because it points out the neutral zones. All right, now the last bar is always yellow because it doesn't know whether it's going to close red, yellow, or green. So the last bar is always yellow, but you end up with these yellow zones. And whenever you see the yellow zone, you know, mathematically calculated that that's the neutral zone of the Fibonacci sweet spot, or of the delta cone of probability. That's the centered delta cone of probability. So we're coming in here, and it's coming down a little bit early right in here. So it's calculating it up in here a little bit, like about right there. And that's okay. That's just how the mathematics work. All right. Calculated a little bit higher for the top side. But that's how that neutral zone comes down into that one delta cone of probability. And if it goes red, it's going to drop out the bottom of the delta cone of probability, right? If it goes red, it's going to go this direction down here out the delta cone of probability. If it goes green, it's going to go out the top of the delta cone of probability. That's all it's telling you. But it makes it easy so you can understand where you're at in the trend by using color coding. You know, color coding's nice. We like color coding. And so we color code the price bars to let you know where the delta cone of probability is, and whether it's generally falling out the bottom, going red, or breaking out the top, going green. Now we got another yellow bar here. Now, again, this last yellow bar, we don't know what it is. The apple's taken off like a banshee today. So we're going to draw our little Fibonacci ruler from top to bottom here, and you can see we're coming right back into the delta cone of probability, right back down center. So you go from the top to the bottom, and then the market has a tendency, what do they say? 68.2% of the time, right? It's going to stay inside of that delta cone of probability. So it came down here, 68.2% of the time, says it's going to come right back, okay? Stays in there 68% of the time. 70% of the time, it likes to just go right back to there. That's pretty high odds. So that's what we do. So that's how you measure. And you anticipate that if the market comes down, it's going to go back to that level. Or if it goes up, it's going to come back to this level, okay? So that's what we do. It's just probabilities. The whole market is a big mathematical model because the computers are the ones that are trading it now. And we're the little retail traders that are out here, you know, pushing the mouse button. We're the ones that screw everything up because we're not as good as the computers. They can trade it perfectly, right? But because we come in here and screw everything up, then the computers have to adjust. And, oh, well, those stupid retail traders, they did this. And so now we have to do this. And we have to make these adjustments. We have to make those adjustments. Oh, and then stupid guys came in and they did this little trick right here, which we need to go to the next section. So this little trick right here, where'd it go? Oh, right here. So then they came in here, and they had a government report. So let's talk a little bit about government reports, because government reports screw up those things too, because they come in and these are the fundamentals. So these are the fundamental nature of markets. So markets move through mathematical models, which are technicals. That's what we call the technical analysis, right? That's what a MACD is. That's what a stochastics is. That's what all these mathematical models are. Okay. And then we lay our Fibonacci rulers over the top of the charts. We have narrow sideways channels. We have recurring price patterns. We have ABCD patterns that are all based around that delta cone of probability and how we're measuring whether the market's how far out of the delta cone it's going to go, how far back into the delta cone it's going to go. That's all technical analysis, has nothing to do with, the Fed chair, right? This is all just reading that stuff in a chart. Now, the reason we do mathematical modeling of the market is because we're small. And it doesn't mean that the big banks and hedge funds don't do mathematical modeling. Of course they do. They pay a little bit more attention to the great big banks and hedge funds pay a little bit more attention to the fundamentals of the market, but they also have trading strategies that they build that they want to use to try and take our money. They have all the money in the world. BlackRock has 10, 13, 14 trillion dollars under belt, right? So they're managing. So they have all the money in the world. The only money they don't have is what you have in your pocket, and they want that too. And so the market is really a system designed to take away retail traders' money. That's what it is. And if you're going to go and put your money in there and you're going to manage it yourself, you got to realize that the name of the game is draw you in, get you excited to come and put your money in the stock market so you can make money so they can take your money. So it is a financial system designed to take retail traders' money and transfer it to the wealthy banks and hedge funds. So if you realize that and you understand that and you're willing to accept that in your trading, then you can come in and trade and realize you are trading against, and we like to think about it as one guy, one man. And that's the one guy you're trading against. You're trading against the market. And then you are the one guy trading back and forth against that one man. Okay. And so that one man's trying to take your money and you're trying to take his money. I got a little slide for that. Of course I do. Of course I have a slide for that. Let's come down here and find it for you. Where is it? Right there. So trading is a game of strategy and wit where you must think several moves ahead to outwit your opponent who is doing the same to outwit you. Okay. So we think of the stock market as one guy on the other side of the chess game. And we're this guy on this side of the chess game. And his name of his game is to take your pieces. And the name of your game is to take his pieces. That's how it works. Okay. And you're like, well, I'm not going to trade. I'm just going to buy and hold. I'm just going to stick it in there and hold on to it for 30 years and never sell it. Okay. What you're doing is you're gambling. I don't like to call it stock market gambling. It's not gambling. It's not betting. It's a fairway along a carnival game. All right. So it's a carnival game because as a carnival game, you can beat the carnival by having skill, practicing. All right. We know that all of the games along the carnival game are rigged. But as long as we know they're rigged, we know that the basketball that you're throwing is smaller and the hoop is smaller and it's farther away and it's higher. It's a different distance than what you're used to. Or throwing the apple in the basket, in the apple basket, the baseball into the apple basket. We know that it's rigged. We know that apple basket is anchored to the wall at a direction that makes it almost impossible for you to pour that in. Doesn't mean you can't. You certainly can. But it's just anchored to a point where it makes it almost impossible. Right? The odds are stacked highly against you that you're going to win. And when you say, well, I'm just going to buy and hold for a long time, what you're doing is you're saying, well, I believe that the carnival is going to win. I believe that BlackRock is going to win. I believe that Vanguard, I believe that State Street, these great, big, huge, giant guys are going to beat the retail traders, which is probably a pretty good bet, right? They mostly have done that in the past. Now, it doesn't mean retail traders can't make money. They certainly can. And smaller hedge funds, can do a really good job too, as long as you understand that's what you're doing. You just need to understand what the game is. If you don't play the game properly, I always pull this picture up because I made this picture. Because the stock market is like it's a game. We're all sitting there around the table and we've all got our cards and we've all got our little spinny thing and we spin that little thing, we move our pieces around, right? It's a game. And on the back of the box, if you lift the box cover up and look at the back, there's rules to the game. All right. Now those rules have been rigged by the guys who made the game. So those rules are designed to help them beat you. That's the rules. And so they wrote the rules and they also wrote the manual that teaches you how to trade. All right. They wrote the manual that teaches you how to trade. You're like, Land Turner has a manual. Watch this. I'm going to go and watch Land Turner's book. Here it is. And you think all these little recurring price patterns, all this stuff, you think those guys didn't make this up? Of course they did. All right. They know all this stuff. Oh, this is secret. Nobody knows this stuff. Oh, yeah. This is the greatest thing ever. These things here. If I learn this, this is a secret thing that those big banks and hedge funds don't know. No. They're the ones who invented this stuff. All right. These are the back of the box rules of the game. If you don't know the back of the box rules of the game, you're going to get your hiney handed to you because you don't know the back of the box rules of the game. So what I'm trying to do is I'm trying to teach you the back of the box rules of the game. Now, I'm not the only one. There's lots of guys out there trying to teach you this stuff. Half of them are trying to teach you this stuff. They don't even know why they're teaching it to you. They don't know. They don't realize it's the back of the box rules of the game. Somebody else told them that, hey, Fibonacci is cool. Go use that. So, oh, look, we scratch it like that. And they don't even know it's the delta Kona probability. They don't even know the mathematics behind it. They're just teaching you Fibonacci because somebody told them that was something cool. They watched some other guy on YouTube that did it. So they don't even understand the whole concept behind it. Then they ask, nobody even knows that that's what MACD is based on. They don't understand that stuff. They're just teaching it because, oh, yeah, I use MACD. Look at this, green and red. They don't understand all this stuff that goes on to this. This is the back of the box, rules of the game. And if you don't understand the back of the box rules of the game and you don't know where they came from them guys in the first place because they teach you how to do this and they tell you what they're doing. All right. Now, I went to the Chicago Board of Trade and worked there for 10 years. And this is the stuff that they teach there. All right. This is the stuff they teach at the Chicago Board. You go to the Temple of Finance, the Board of Trade, right? The CME, the big exchange. You go to their education center. This is what they teach. Right. So I'm here to tell you, I did that for 10 years, went to those education centers. I was a teacher there. I was teaching people how to use computers in those education centers, and they taught me how to trade. So for 10 years, I got to learn how to trade the way they trade if I would teach them how to do it on a computer. And that's where we come up with track and trade. That's why this software does all these neat things, is because this came right out of the Chicago Board of Trade. All right. So this is the software that was designed, that we designed to do what they told us to do. So that's how it come about. That's why they have all these little color codes, and that's why I have, the MACD and stuff. But everybody has MACD, just most of them don't even know why they use it. So that's how this all works. And then you have your mathematical model, which I've oftentimes pull up for those of you guys who have been here. You know that this is the Richard Wyckoff accumulation distribution model. And this is basically how markets work through. This one here is the bullish market. All right. So again, if we pull this up, let's shrink it down a little bit like this. Oh, grab the corner. Come on, corner. This Apple stuff is kind of, maybe I need to move to Macintosh. I don't know. So Windows stuff, I mean. Okay, see this pattern right here? This is a roadmap. Now, it's not perfect because this is fixed in time, and markets are dynamic. Markets can move and do different things, right? But look at this thing. I'm telling you, look at this thing. This is the accumulation stage right here. And this is the accumulation stage I showed you over here. And then the market went up through this trend. See that? 1, 2, 3, and it went up and created this little peak right up in here. It's almost like this was not drawn because Apple did this. I didn't draw this because Apple did this. No, Apple just did this, and this was drawn 30 years ago. Not by me, by Richard Wyckoff. I'm just teaching it to you because this is what they taught me at the Board of Trade. They handed me that and said, that's what markets do. Why do markets do that? And then we went into all the mathematical models, reasons why they do that. And mostly it's self-fulfilling prophecy, because the guys that are at the Chicago Board of Trade take all this information that they take them, then they go back to Wall Street and they program it in. I programmed it into this one. I made this software program. When I came out of the Chicago Board of Trade Education Center, I created this program. Of course, I created this program while I was there. So that's, I used them as to build this. So we built this while I was there at the Chicago Board of Trade. And then they taught us this stuff. And then the guys that were in the classes with me, I created this software, and then they went to New York City and created other software that they trade the financial markets and manage big money on Wall Street with. See how it works? So this is the software that I created when I come out of the Board of Trade. They went somewhere else and created other software to manage big hedge funds. And so that's why it does this stuff. We were all taught the same thing. So I'm teaching you what I learned. And see this little map right here? This is your accumulation. This is your distribution. This is your down here. And look at this. And look at that. It's even drawn right here. See this? Pop, boop, pop, pop. It's right there. Pop, pop right there. My gosh, you guys can't make it any easier for you. Now, do all markets do this? No, of course not. But when they do, when they start to do this trend, it's pretty predictable. I mean, markets do it over and over and over and over again. And they'll do some variation of this, And of course, if you have a bearish market, you have this one here. This one's a little bit more bearish, meaning that the market doesn't come back down just halfway. It comes all the way back down to the same market here. And this is kind of what we saw in silver and gold, right? And then the market starts to rally back up out of there. And then oftentimes it'll match this one and turn and drop back down. That's a bearish market. Okay. So it comes down, it goes back, it bounces back up and goes sideways, and then it flushes one more time and you get that two big drive down. Right. So that's the bearish side of it. Could probably take this image and put the next leg on it, but it's kind of assumed. But this is the bullish side. See the difference? So you got the bullish side where it only comes down halfway back into the delta cone of probability, and then it turns and starts to go back up. This one here comes up, goes all the way back down to the bottom, goes up halfway, turns and flushes down one more time. So you got two delta cones of probability here. And this one, what is this one doing? Apple is going into Apple's going into this one here. It went only back halfway. It came right back down into the delta cone of probability and starting to rally back up again. So this is still bullish. That's what that is. That's indicating a bullish move, obviously. But we'll probably get a little pullback because market's moving waves, right? And we can just kind of measure. What we like to do is we come in here and we measure how big these moves are from here to here. And then we say, well, that one did that one, that, and then it did that one, that. Oh, look, they're all about the same size. So then we can just take one of these on the average and just say, well, we're going to just come over here and say it's going to probably go about the same. Oh, it just did. It went exactly the same size. So we'll probably get a little bit of a pullback in here somewhere just to give it a little energy. And then it might do an ABC and come back up and test its previous high. And that would be our little ABCD pattern, right? So it might go up, come back down, and go back up again. There you go, up to the top. Now, it doesn't mean it can't make a third drive down. It certainly can. It can do this little fakey dakey do thing where it comes down, makes a little ABC pattern, come right down to 100, 135.9 right there, just like a train on rails, because that's the Fibonacci golden ratio. And it doesn't mean it can't do one more of those, right? It can come down here, touch this one, go up, create that, and come right back down and be down here in the 61% level, because it didn't go to the bottom of the one standard deviation. It just went dead center to the cone of probability. So it could come back down, and that's the struggle, right? So if we take that same concept, now we're going to go back over to gold and silver. Okay. I want to get into gold and silver land. You're talking about Apple. Well, I'm talking about Apple because it's the perfect model. All right. Now we're going to go apply that same concept. If I can find it, we're going to apply that same concept over here to gold and silver. All right. Now we're going to go do it in the stock market because I know some of you guys don't trade gold and silver. Gold and silver. The futures market is a good place to trade gold and silver because it's a commodity, right? Now, there are some ETFs, exchange traded funds, that you can trade gold and silver with. But the whole idea is to look at this and see that same concept, okay? All the way from top to bottom, back down here to the Fibonacci sweet spot into the delta cone of probability. And that's where this market's at right now. Now, it's still flushing. It's still going all over the place. There's a lot of volatility in here. In fact, I was looking at it earlier on the day trade, and I was like, wow, we should be day trading this thing because it was, look at these beautiful moves in here. We could have made some money, but it's a huge market. Silver is a big market. Watch how big this is from here to here. That's $1,225. Just that one little move right there. And look how fast. See, these are just range bar sixes. So they're tiny little price bars. That's a lot of money. Those are big bars. So you got to have deep pockets to trade this thing. I think there's a mini. Let's go see if silver's got a mini and micro, or a micro silver. No, it doesn't have I think gold does. Let's go see if gold. I think gold has a micro. Gold micro. There it is. So we could pull up gold micro. Oh, we got to be in the next contract month out. We got to be in April. All right. So there it is. There's the daily. Let's come down here. Let's just pull up a 1 minute chart first and see what that's doing. Now, I'm going to show you how to just get in and buy you some gold and not feel like and so you can sleep at night. You got to be able to sleep at night when you buy this stuff because it's going crazy right now. You don't want to miss out, right? You got FOMO. You don't want to miss out. So I'm not talking about day trading. That's one way to well, if you lose money, you don't sleep good at night when you're a day trader. So it's starting to break. Okay. See that little pullback in there? And then we're in an uptrend. So we would anticipate that'd be a continuation of a rise in price. So if we wanted to day trade, we could put a little order in right there. That'd be a perfect little setup where it crossed that green line and then we anticipate the market's going to continue to go higher up those green bars. But this one here, this is a mini, so that's $85 from right there. So it's a lot smaller. It's not gonna kick your butt so bad if you want to come in and do a little day trading on gold. And since gold is usually moves really slow, and look at the spread, it's really tight. So that would be a good one to move on. We could come in here and we could go down to maybe let's try first range bar 8, and that's going to be even smaller than a 1 minute. All right, so it's on this one, it's flushing. Woo, look at it go. It's going to bounce around a lot though, because this is a tiny little chart, and when my prices move, they kind of jump around a little bit. Range bar 8 might be a little bit too small. It moves too fast. Oh, look at that. Woo, that's crazy. Gold's nuts. Let's go up to a bigger time frame. Let's go to 10. See, it's too wild for the small, tiny little charts. You're going to go up to where it calms out a little bit. Maybe 1 minute's probably about as good as you're going to get. That's a little better. Those range bars are too tiny. All right, so that's how you might day trade it if you wanted to day trade it, and then you can sleep at night because you're out of the market. You're not going to stay in the market. But make sure when you day trade, you if you get in and if it starts to go against you, just get right back out. Don't hang on to it like it's going to come back and eventually I'll get my money back, because market can stay irrational longer than you can stay liquid. All right. It can drop. It can just, once it starts going down, you're like, well, I'll just stay in. I'm losing money. Oh, I'm just going to stay in. Oh, I'm just going to stay in. Oh, I'm just going to stay in. Now you're down $1,000 and you're like, oh shit, I shouldn't have just stayed in. Okay. Because it may never come back to where you need it to. So don't do that. Don't trade like that. All right. What you want to do is you want to come in here and you put your little order in on these little breaks from red to green on these little pullbacks. This is a bullish trend, so it's higher highs and higher lows. So you want to anticipate a continuation of the trend, right? The trend is your friend until it ends. And so what you want to do is you want to just kind of anticipate from red to green right there. You put your little order in and just hope that it continues up the green trend. That's really the simplest, easiest way to trade. And you got tools that can help you make that happen. I mean, that's what this software is. It's in here. It's got fancy dancy tools to help you actually trade. All you have to do is decide when, and then the computer will trade whenever you want it to. It just takes over and does all the trading for you, but you just decide the point of when. All right. And all you do is just click the button, and then it'll sit there and trade for you. So now we're going to come over here, and I want to look at, that's gold on a short-term basis. Now we're going to go look at it on a longer-term basis. You're going to say, well, Lan, I want to hang on to gold for, a long period of time. Look, it's taken off. It's rallying from these real lows down here. It was at $4,422 an ounce, and now it's all the way up to $5,000 an ounce. It's gone up $600 an ounce since the low of yesterday. So it's really on a banshee run. And you're like, well, I'm missing out again. I'm missing out. How do I get into this? Well, if you wanted to, you could come over here. We're going to go over to the stock market version. You can do it in the futures version. Again, do the little day trading over there if you want. Or you could do the same thing, but I'm going to show you in both markets. I'm going to show you how to come in here, and we're going to go over to gold. And the way you do that is with the symbol GLD. All right. GLD is gold in the stock market. Now, it's an ETF. It's not actual gold. They're actually taking your money and going buying gold with it. All right. And then silver, same thing. Now, silver's still coming down a little bit. So gold's already turned and starting to rally. So silver probably going to turn and rally too. But it's down here like this. But if you wanted to buy something, you're like, but I'm scared to buy it. I don't know if it's going to go back up and break these highs and make me all kinds of money. So what you do is you just buy some insurance. So it's a good place to buy it over here because you got options, and options are the insurance. So we're going to go out, and so very simple. We're going to come in here and we're just going to buy. There's $80 a share. We're going to buy 100 shares. Okay, so that's $8,000. So you're going to buy $8,000 worth of silver. Very easy. That's a good investment into silver. So you're going to come in here and you're going to say, well, I don't know if right now is the best time. Nobody knows that now's the best time, right? You just want some because you can buy some more, you can buy some more. So you just come in here and you hit buy. Now you got 100 shares of silver. There you go. Now if it goes up, you make money. But what if it goes down, Lan? I'm going to lose money. Well, you could buy more, right? You could double down. Not buy all of your money at once, and you could dollar cost average down. You could put your little limit orders in here, and you could do that, or you could put another little limit order in here and do that. Just buy it as it comes down, and then eventually it'll stop going down, and hopefully it'll turn and go back up again, right? What if it doesn't land? What if it doesn't? Okay, well, then dump these. See, I don't want to do that. So that's not a good strategy. So what we're going to do is we're going to come in here, and we're just going to buy a put option. A put option is an insurance policy. That's what a put option is. That's its primary function, is to be an insurance policy. And so we're going to come in here. We're just going to buy 17 days of insurance. We should know within 2 weeks, right? So we just buy 17 days of insurance. Now, I like to buy insurance on the ones that are dark in here. See all these are light, and then this one's dark, or maybe it's the other way around. These are all darker, and then this is the light one. These are your quarterly options. That's where you're going to have the most volume and open interest. So those are the ones you kind of want to build your strategy around. So we're going to buy 17 days worth of insurance. And you're like, I don't know anything about options. It's not hard. It's just another type of order. So we're just going to come in here and say 17 days. And it's going to, your insurance policy is going to last 17 days. And then you come over here to your options tab like this. And now what we're going to do is we're going to come in and we're going to just slide our options, our put option. We're going to buy a put right here, and we're going to just slide it up there. See that we're going to put it how close do you want the insurance. Now, if you put it right on top of the green line, you're going to have a perfect insurance. It's like buying a car, right? And then you go buy your insurance. And when you buy your insurance, do you want 100% protection? If you do, you're going to pay more money for the insurance policy, right? But if you crash the car, covers 100%. Are you that kind of guy? Do you want 100% protection on your insurance? Or do you have a little deductible? Are you like, I'll have a little deductible. Okay, well, if you want a little deductible, you just pull your put option down a little bit farther. You don't have to pay as much for it. Now, you can see over here in the left-hand side on the screen, you can see on the left-hand side, it says pay $442 for 17 days worth of insurance on your $8,000 investment. Okay, so you got an $8,000 car there, and you're going to pay $442 at that rate to protect it against falling below that green line. So that's the name of the game. That's what you're doing. It's not a big deal. It's not hard. It's just an easy concept. So you say, well, down there at the very bottom of where it was before, that's $179 for 17 days worth of insurance. Okay. So you can say, well, I'll put it in there. But now you're going to have a deductible between where the market's currently trading and that green line. The insurance doesn't kick in until you've already lost $1,241 of your $8,000. Once it goes below there, well, now it's protected. All right, you have insurance. So anything down here in this region, this is all protection. It's all protected. Okay, so that's good. That's a good deal. So you're all protected for $179. So you can do that. And now that's all you have to do. Now you got your shares. And if it falls down here a little bit, you want to buy some more, you can buy some more. You're not going to have insurance on it because this each put option puts the insurance on 100 shares. That's why I bought 100 shares, so that I could have insurance on 100 shares. Now, one of the things is, one of the magic things about options, and this is going to get a little bit more advanced, see the delta right here? Now, the delta is how much options you're covered, okay? So we're going to come down here. We're going to go to our put options, which are these here, because these are our insurance policies. And as we're going to slide down, you're going to find the one that we just set on the screen. And it's right there. There it is. It's the green one. And you can see it's got a delta of 1.8. Now, that means it's really only insuring 18 shares, if you look at it that way. All right. It's got insurance on 18 shares. Why? Because you took a big deductible. So it's going to only insure 18 shares at the beginning. But when it gets to, when the market, the snaky thing here, when it gets over to that purple line, well, it'll be protecting 100 shares. So it's called the delta. All right. That's why we have the delta cone of probability. There it is right there on your screen. It's part of the option strategy. All right. That's where that term came from. That's why I coined it. So this is where your delta cone of probability is, and you are putting your insurance policy down towards the edge of the delta cone of probability. The likelihood of the market going down there is very slim, right? If we're going to go to the full, let's draw our cone in there. Where's our Fibonacci cone? We're going to go from the bottom of this trend right here all the way to the top. So the delta cone is right there. You can see there's the delta cone of probability. So it went down to the bottom of the delta cone of probability. What's the chances that it turns and comes down here? Now we can draw that other section in there into the delta cone of probability. It's called 78.6 and 76.4. Right there. So that's the other delta cone of probability line. It's hard to see. We can come over here to the preferences and make that a brighter, I like a brighter magenta. Let's go to this magenta. There we go. Oh, it's still hard to see. Let's make it a little bigger. There we go. Man, can't we get something brighter than that? Let's go lavender. There, well, you can see that a little bit better. Maybe make it a bigger line. So there's our next line right there. Okay. So that's our, here, let's save that because that's good. Let's come in here and go to the preferences. We're going to save that as our defaults. So now all of our Fibonacci rulers will draw with that line in there like that. So now what we can do is this is going to come down here. And if that's the next level down, you're insured from this point here down to there. Of course, you're insured all the way down. As long as it's inside that purple line from that green line down, you're insured. You have insurance. So you're going to get your money back. That's going to lose as much money. This is going to lose as much money as this is going to make. So this is going to make as much money as that one's going to lose. But it's $190. You paid your insurance. That's your premium, and you don't get that back. You paid it. It's gone. Once you pay for it, it's gone. Now, if you bail out early and say, well, this market's turning and taking off and going to the moon, and it's obvious, then it's not going to ever come back down and touch my line. Well, you can close that out and not have to lose your whole $191 insurance premium. You can get some of that back. All right. You're like, well, I didn't use all my insurance. Can I get some back? You say, absolutely, you can get it back. All right. So you can scoot that in and get a little bit better insurance. You can put it right up here close. Say, I want really good insurance. Okay. So if it falls at all, well, you're going to give up $490, but you're protected to the downside. And you just protected another, how much is that? Between where it's at and where it was, another $800 worth of losses in case the market comes flushing down. The only thing you're concerned about is if the market doesn't come flushing down, right? Well, I'm going to lose my $487. Well, you're going to lose your $487 anyway. You just paid it. But what it's going to do is it's going to keep your 100 shares from losing even more on the way down. But what happens is, what if the market turns and takes off and goes up? Well, if it takes off and goes up, let's say it goes back up here. Well, you just made $2,000. Well, that's easily going to cover your $487 of insurance so that you could sleep at night. How badly do you want to sleep at night? Do you want good insurance or bad insurance? That's what you're doing. You're buying insurance. Now, there's all kinds of strategies that you could put in here to try and reduce that $482. All right. You don't have to put that in there. You can come in here and watch this. There's a cool little trick that you can do. You can say, let's get rid of all the drawing tools. And let's come in here. Let's blow this up so you can see a little bit better. And there's just some little tricks that you can do to reduce the cost of your insurance policy. So what you can do, since you're selling this one, or you're buying this one, you can sell one down here to help you cover the cost. So you can come in here and say, well, I don't really think, if we're going to put the delta cone of probability back on there, and we're going to measure that out, and we're going to say, well, I don't really think it's going to break below 78.6, because if it does, on our delta cone of probability, we know that for it to go there, what's the odds? Come on, draw these in here. Where's our odds? Our odds were pretty. I thought I could get to it faster. There it is. Our odds are 99.7. Actually, this would be here. 95.4% of the time, it's going to stay inside that window. So the odds are really good in our favor that it's not going to come all the way down to 78.6. Doesn't mean it can't. Certainly can. All right. But the odds say it's going to kind of stick around in this region here. Okay. It went all the way up there. Pull back. It's going to kind of hang out in here. Maybe 78.6. But before it turns and starts to go back up. So what we're going to do, we may be getting in a little early, so we're a little worried, buy a little insurance, but we don't want to pay $485 for that insurance. So we can come down here and we can actually sell somebody else some insurance. So we're going to sell a put down here. All right. And we're going to put it down below 78.6. Oh, that's not very good insurance. 17 days that far out. So we might have to come up here a little bit farther to get a little bit, make it worth it. Okay, so we're going to do this. Well, let's just put it right here at 61.8, just underneath 61.8. All right, right underneath that previous low. Well, that's going to give us $156. So now we're not going to have to pay $482 because we're going to receive $156. So 482 minus 156 ends up being $327, right? That tells you right there. See that little calculator right over here tells you. You're going to pay $327 for your insurance. Yeah, but what does that do when you sell that? Well, it means that you might have to buy another 100 shares right there if you wanted to. But it's covered this one here. So you don't really have to. So this is where you could buy another 100 shares. But that's what that would do. But you don't have to because you got it covered right here. So these two are going to offset each other. It just means you're not going to have any insurance below there. Okay. So now you're only insured from here to here. And you saved yourself $156 to say, well, I don't need insurance below that point. If it starts going down to that point, then I'm okay to start losing money again. That's basically what you're saying. You're like, well, Lan, I don't want to do that. I don't want to lose money down there. Well, you could come down here If you don't want to have, if you want to have another insurance policy, you can really get fancy and you can sell another put down here. You can sell one down here and get some more money. Okay, so you're going to sell some down here. Now you're going to be anything below there, you're going to be in trouble. Okay, you're going to have this. You're going to buy this one. You're going to sell this one. Now you're going to sell another one clear down here at 78.6. Now you got two. You got one naked here. You can make that two to get some more premium out of it. And then that's called the 1-1-2 strategy. And so you come down here, you're paying $475, you're receiving $155, now you're receiving $100. Now your insurance policy is only $219. And now you're insured to here at 100%, and you're insured down to here partially. Okay. But this is all profit zone in here at this point. You're all going to make money. This thing's going to come down and it's going to cover your 100. Now, I'll show you another little strategy. You want to see something else cool? What if we didn't even have this on? What if we close that position altogether? This will close your position. Okay. What if we just had the options? That's all we had. Now, if we just had the options, this is your profit zone right in here. This whole area right in here, if the market fell down in there, you'd make money. You would make money in that profit zone right there, because that's what this is. This is making money, right, to cover your loss of the one you had long in case the market went up. Well, if the market just goes down, and how much you have to pay? You only paid $200. And if the market keeps coming down, you make money down in here. You don't start losing money until below 78.6. And again, well, the probabilities of that happen are pretty low, 95.4%. Okay. Falls out the bottom of that Fibonacci sweet spot. Well, that would be going down here even. 90, pretty low probability that it's going to come way down here. You can see it on here on the scale. Shows you right here. Chances of it going down here, probability of being down here is 15%. Right there. There's your delta cone of probability. It tells you the actual numbers. The chances of it coming down to that bottom line right there. Is that one? I think it is. 155. No, that's that one. Where are we at? Oh, this is here. It's 52. Look, the odds are there. There's your 94.15. I was looking at the wrong number. 5.84. It's 94% chance that it's not going to come down to that red line right there. 94, it says it right there in the delta cone of probability. See it? See that number? That's this one right here. 99.7 if you went a little bit further. But we're right at 94.12. See, you got a pretty, and if the market comes down in this circle, you make money. If it doesn't, you just $219 all you lost by putting this on. It's $219 to take the downside of this and make money if the market comes down into that circle. And anywhere in that circle, if it makes money, you can take it off. Just take money and close the whole thing out. You don't have to wait for it to hit the purple line. The purple line is just max profit. That's where you'd make the most money. If this market just came right down into here and hit this purple line, anywhere underneath that green line, this right in here, this is your max profit. You're going to make the same amount. You're not going to make more if it comes down farther. You're just going to kind of like right in here, anything underneath that line right there, this is your max profit right there at that line right there. That's max profit. Okay. So this whole area right in here, this is all profit if it goes in there. That's pretty cool, right? You only have to pay $219 to get that, to put that strategy on. You're like, I don't want to pay $219. Can I get that for free? Well, we can jigger it around a little bit and try. Let's come up here and let's put this one up here. We'll put it this a little closer. We might have to pull it a little farther away, actually. We'll try it. Let's just put it somewhere. We'll put it right there. That's $300, but we're going to move this insurance policy up. We're going to have to bring the we're going to this is called the bear trap right here. Call this the bear trap. So if I do that, I'm going to bring this up a little bit to get it. I'm trying to make it free. What would we have to do to make it free? Well, that's $100. It just makes your bear trap smaller. There's $81. There's $56. There's $13. Can you pay $13 for a strategy? That means right there, this is your bear trap. So if the market comes right in here, anywhere in there, you're going to make money. All right. So, and it's going to make money even down below. It's going to be the bear trap is actually something like this. I can't draw a red, but that box is included in the bear trap. Something about like that. It's probably not quite that big. Maybe more like this. Okay. So that's let's get rid of this because it's not this one. So inside that red box and down off that ledge right there, anywhere inside there, you're going to be profitable. You're going to make money. How much am I going to make? Well, it depends, because you're going to make the money to here. That's $500. And then down here, you're going to make your extra $158. So you're going to be making the max profit will be $650. So anywhere in that box below the red line, so the max profit is below here. So anywhere in here, this is going to be $650. All right. That's what you're going to make if it hits the purple line there. Up here, it's going to be any variation of that. It's going to be a little bit less. Okay. But so that would be your max profit. And then down here, it's going to start getting smaller. Once it goes down here, it's going to start getting smaller all the way down to 0. Oh, I didn't want to move that. I want to bring that back up where it was. I want to move this one like that. So anywhere down in here, in there, that's where you're going to start. You're going to start all the way back down to 0, where you're going to lose all your money. Okay. So you're going to make money, make money. And as if it comes down, it's making you money, you just take it off. You don't have to make max profit if you're worried that it's going to go down below. So that's just a real simple little option strategy. You're just doing, it's called the 1-1-2 strategy. Now there's all kinds of variations of that. You can do 2-2-1 strategy, or you can do the 2-1-2 strategy. We'll talk about those in another time. But this is just a nice little way of being able to get into silver and protect yourself using options so that you can sleep at night. Again, when we just clear all this out, let's exit chart. I'll check all options. Let's all exit chart, yes. Okay, so we're going to clear all that out and clear off all of our drawings. The simplest and easiest way is just, you're in silver, you're in the stock market, and you want to buy some shares. Just buy some shares. There you go. You're in. But now you want to have a protection. You can come in with a stop, and you can just say, well, if it goes down, I'm just going to get out, and I'm going to lose the difference between where I got in and where I get out. So you can put a little stop in there, put it relatively close if you don't want to, however much you're willing to give up, the distance between where you get in and get out. That's $323. And you're like, well, that's my stop. Well, for $323, you can buy a put option. So you don't have to actually have a hard stop. You can have what we call a soft stop. And that's why I'm saying you can use options if you just, spend a little bit of time to learn how options work. And it's not hard. Everybody's scared of options because they look at these tables and they're just like, oh no, just stick with me. They're not that hard. This is just the premium. This is what you're going to pay for it. Okay. So we're going to come in here. And $300 is what our stop was, right? We put our stop in there. It was $300. So you come down here and you say, well, for $350, they just buy this one. So you're going to buy that put, and it's down here. That's the difference right there. So anything below there, that's $350. That's $728 risk. Anything below $728, you're covered. But the idea is that you don't get stopped out. So if in this time the market comes down, well, you're down 728 on your drawdown. You might want to buy some more. But then if it's down here, that's helping you sleep at night. You're not losing any more, because then it might just turn around and go right back up again. And as long as it's above that green line, well, you're going to lose your 347 because that's your comfort pillow, right? Keep you sleeping well at night. And then if it goes back up, well, you paid your 347, but if you want to, you could cash out. Take your 347 off the table. You made some money on it. You made $728. Well, that would be here at the purple line. Or you could buy more insurance. You can buy more time on your insurance, but it's going to cost you more money. So you come out here and you say, well, for that same insurance policy, kill this one. Now it's going to be, if we come down here, we're going to be about double that. So we're going to go in and we're going to say, we're going to buy this insurance policy. And you can put it wherever you want. You can have it down here. You can put it up here. It just depends on the closer you have it to where you're at, the better insurance you have, but the more you have to pay for it. That's all it is. Buy a put. That's all you're doing. Very simple, very easy. You just drop it in there and you say place order, and you're protected. So that's how you can very simple, very easily reduce your expenses to have your long position. So again, you can do the fancy 1-1-2 strategy, or you can do a 2-2-1 strategy, or you can do a 2-2-2 strategy, whatever you want to try and make that math work to give you the number you're looking for and give you the profit zone that you want. So that's silver. Let's go over and look at gold. So if we come over to gold, we say, oh, I want to get into gold. I'm so excited. Gold's coming down, giving me an opportunity to buy low, sell high, buy the dip. But I'm scared to buy the dip, because if I buy the dip and it goes down some more, then I've already lost the dip. Well, it's already come back this far. It's already come back that far. It's come back $3,500 for 100 shares. What's 100 shares going to cost? A lot. What's 100 shares going to cost to buy gold? Gold, 100 shares is going to cost you $45,000. You want to buy 100 shares of gold? Probably not. Okay, so how are you going to protect it? We're going to buy some gold. We're going to buy 25 shares of gold. We're going to buy $11,000. So we're going to come in here. Actually, let's just go right down to 10,000. We're going to buy $10,000 worth of gold right here. Okay, going to go buy market. So we got ourselves $10,000 worth of gold. How are we going to protect it? Well, we're going to do the same thing. We're going to come in here with the options, and we're going to come down here. And how long do we want some insurance? Maybe I want a lot of insurance. Maybe I want 100 days worth of insurance. Okay, well, it's going to be more expensive. You're going to pay $2,600 at the money. That would be a perfect hedge, meaning that you'd not lose any money below the green line where you got in. Okay, well, I'm willing to do that. Okay, well, come in here and just right click and say buy the option. It puts it right on top of it, right? Exactly where you, well, that's one in. Let's put it one out. So it's going to cost you $2,630, and it's going to basically protect you right where you got your 100 shares at. It's not exact, because this one to go 100 shares out is just a tiny little bit, just a tiny little protection, or a little tiny deductible. You could put it above it like that, and then you would have you wouldn't have any deductible at all. Okay, but that's $2,900. We're going to put it one down. You're going to have a little tiny bit, $600, $700, $800, $900, $300 deductible. Is that okay? $300. So there you go. So that's your put option, and you're protecting your downside protection. But now you're protecting way more than you need to, right? You got your put option, and you only have, how many shares do we have? We only have, how many shares was that? The gold. This is the chart. So we only have 22 shares. So you don't need to have this one here, because that protects 100 shares. Oh, I see how it works. Because if you come over to the options chain, remember over here, I told you this delta right here tells you how many shares it's protecting. And it's actually, right now, it's protecting 49 shares. Right at this point, it's protecting 49 shares. But at because the delta cone shrinks and grows, right? At delta, at right here, once the market hits that purple line, well, then it will have protected 100 shares. But you don't need 100 shares of protection. You only have 10 shares. How many shares did we say again? I forgot again already. 22 shares. So we need 22 shares of protection. So what we can do is we can grab that and draw it all the way down here. And we can go down until on the delta cone of probability, the put options, we're on the 100 days. We're going to protect ourselves all the way down to 22 shares right there. Okay, now that's 22 shares. So that'll start making as much money on this option today, because that 22 shares is going to protect that, right, at the same level as what you've got in there. So it will make as much money as this one is losing. So, and it's going to cost you $1,000. It's a lot less than the one where you had 100 share protection. But you're going to have a lot better protection, right, if it's up here, because it's going to cover 50 shares and you've only got 22 shares. So if it falls, you'll actually make money. But you're going to pay a lot more money in insurance premium. Your insurance company is going to pay you more than you're losing. It's like insuring your car that you paid $10,000 for. You're insuring it for $20,000. And the insurance company see you do that, they're not going to give you the 20 grand. They're going to say your car's only worth 10,000. But here in the financial markets, we do. You can get a better insurance policy than what you have a position on, and they'll give you the difference. So if we go up here where we've got a delta of 40, so we're protecting 40 cents right now, or 40 shares. Well, if you bring this all the way down to 22 shares, where we're at right here, 22 shares, we'll bring it down one more. We can grab it right here. 22 shares. Now you're protecting 22 shares, okay? Because you got a delta of 22. That's how you do it. And then out here, it'll be the full 100 shares. So if it fell down here, and it fell all the way down here, you'd make money, because it's protected 22 shares here. But the more time goes by, the more shares it's called convexity, and so more shares you're going to protect. You're going to make money, because out here you will have protected 100 shares. Of course, if it goes right to there, you won't make any money. It's got to be below that green line. Anything below that green line is where you're going to get your money. So if it went down here, the market went all the way down here and touched that purple line, well, you'd make $1,890. And you would have protected yourself here. You didn't lose it. Well, no, you'd have lost money there, because this only makes money from here to here, right? It only makes money from here to here. But it'll start making money. If the market turns and starts to drop right here, if it turns to drop, this will start making money at about the rate of 22 shares. So that's cool, right? That's how it works. So that's your insurance policy for 22 shares. You don't have to buy insurance for 100 shares. You only have to buy insurance for 22 shares, which is way down here. All right, that's how you do it. That's how you do it with options. And of course, like I said, there's fancier option strategies. So you can come in here, buy some, sell some, buy some, then sell some more, and then you can collect some more premium further down in areas that have high probabilities of not the market ever going there, collecting that premium and then applying it to the ones that you bought, so that you can lower the cost. All right, but you do take that risk that if the market does flush all the way down there, then you're not covered. You don't have any insurance to cover those, and you have to. That's where you start losing money again. Okay. But I would rather start losing money way down here than start losing money way up here. And that's the trade-off. You're just saying, well, between this, I'm not going to lose any money between this box, but I'll start losing money again down here at this box, below this box. So I'm going to create a box zone where I'm not going to lose money. And then the chances of it getting below that box zone is really low. So you're like, well, I'll take that risk. I'm just going to kind of take my risk down to the bottom of this box. And you do that with options by buying some more on the other side. I know it might sound a little bit complicated to do that, and we'll do that in another class where we can talk a little bit greater detail about options. But options are so powerful, and they have so many things you can do with them. And it's just a simple process of buying and selling, collecting premium to pay for the ones you buy. So you sell some to buy some. You sell the ones that are in low probability for the ones that are in the high probability, like, that are going to move against you. So you pay for some with low probability to high probability, and it reduces your risk and reduces your probability of losing money. That's all we do. Just kind of play the game. And that's what the big boys do. They play that game. All right. Does anybody have any questions about gold and silver? But that's how you'd really do it if you want to get in right now. Otherwise, you can come down and you can do a little day trading and just be out at the end of the day. So you don't have to worry about it flushing. You can come down here to a 2-minute chart, and you can do options on 2-minute charts too. You can come down here on gold and you can say, oh, look, that's where we got in right there. But you could come in and put a little teeny short option on here. You say, well, I'm in right there with my 22 shares. You come in here and buy a little put option right here. Go to a one day put option, and then we're going to buy a put right here. Well, you got a little protection to the downside. That's $500, but you're protecting your 22 shares for one day. You could do that. Okay. Or you can come in here and you say, well, I think the market's going to fall. You just don't even have to use this one. You close this position. We'll get out of the market altogether. Right now, we're not in gold. Let's turn on our Heiken Ashies. So now we're not even in gold. Now you can come in here and you could sell a call. You could sell a call up here, right there. You're going to receive $500. Now, and this is one day. So by the end of the day, now this is one day, meaning that today's 0 days, tomorrow's one day. But as long as it stays below that red line, you're going to, and hits the purple line. Of course, the purple line is it's 1 day out. There it is. So this is tomorrow, 2-3, 1 day, 1 day left. I don't know. 2-3 is the expiration at 2 o'clock. So what's today? Oh, so this is your 1 day. Okay. So this is your 0 days till expiration. So if it stays, this is how you can make $500. If the market stays below that red line and hits that gold line right there, which is just today's end of day. Over in the futures market, they say 0 days. Over here, it says 1 day. 1 day left. That's interesting. Let's go look, because I think in the futures market, they call that 0 days. Let's go to the options. Well, all I got is 3 days. Go to the S&P. See if I can find 0 days. Usually they expire on Friday. And then there's 0 days till expiration. But this is saying 1 day. And then it's showing us that today is the expiration, 2/3/2026 at 2 o'clock. And that's today. All right. So there you go. You sell this one. Now, how much is that going to cost? We're going to have $11,000 in our account to sell a naked one. But we don't have to sell a naked one. We can come up here and we can buy one up here, buy a call way up here like this. Now we only have to have $1,000. Let's bring it in a little closer. $1,000. Okay, so now we only have to have $1,000 in our account, and we're going to pay $177, but we're going to make $444, so we're going to make $277. So as long as that market stays below that red line and touches this yellow line, you're going to make $277, and you have to have $1,000 in your account to do that. Why are they going to have $1,000? Because they're going to margin you at max loss, which is the distance between this red line and this green line. That's $1,000. Okay, so they're margining you at the $1,000 loss. And that's okay because you got a probability. You don't think the market's going to go up anymore. You think it's going to go down for the rest of the day. You don't have to buy a position. You just sell this one and you make $455. You buy that one to reduce your margin amount. So you don't have to have $11,000 in your account. Now you only have to have $1,000. But if you want that $175, don't put that on. And then you'd have to have $11,000 in your account. But that would mean you have to sit here and wait because if you don't have a stop, that's really basically your stop order to get you out in case you're wrong. But it's an option, so it's not really going to get you out. It's just not going to lose any. It's going to start making money above the green line. Okay, so that's how that works. So that's a way you could day trade with options. I like to do this. This is the way I like to day trade with options because you don't have to be right in the complete direction. You don't have to sit there and worry about stops and getting stopped out and getting in and stopped and get out. You're getting in. You kind of wait until about noontime when the market generally has, it's reached its peak. And usually the markets, not always, but it's pretty common, and you've seen it yourself. Markets have a tendency to rally way up in the mornings when they're all excited, and then for the rest of the day they get tired and they just kind of drift lower for the rest of the day. And the markets are kind of choppy and they're up and down, and they're not really good to trade because they go all over and they just kind of do this, and you get stopped out. No, it's no fun. You just get stopped out. But the market just kind of drifted lower the whole day. So you're like, damn, if I would have just sold up here and just held on to it and not used a tight stop, I would have made money. Well, that's what this is doing. You're just going to sell a put or sell a call right here. This is just called a credit spread, and they're going to give you $450 to do that. But you're going to buy the 176 insurance policy that if it goes above the green line, you're not going to lose any more money, which is $1,000, which is your margin amount. Okay, that's how the game's played. You got to know the game, right? You got to know the rules to the game. Once you know the rules to the game, then you can play the game. And that's all you were doing. It's just a game. Just learn the rules of the game. And then you can come and play the game too. And there's lots of different ways to play the game. So we're going to come in here, and this is the way I like to play the game. I like to do it this way. So I just think the market's not going to go up any higher. I think it's done. I think it's exhausted for the day, right? Maybe there's no more news coming out or anything. We can come and look at our news channel. Where's our news channel? Right here. We can come over here, economic news. We don't have any news today. It's 2:30 this afternoon. Crude oil is going to make an announcement, but that's not going to hurt us. Jolt's job openings at 2:30, but that's after the market close. We can be out by then, right? So this 2:30 UTC 7, which is my time. So at 2:30, but that might move the market a little bit. So we need to be careful on that one. So by 2:30, we want to be out, but that's markets close at 2:00. So we want to close this position out before that happens anyway. So if I think the market's going to just kind of drift lower at this point, generally I like to wait a little bit longer. I generally like to wait until about noontime and then just let it drift lower. And you don't have to do 0 days till expiration on these either, but they tend to, the 0 days till expiration, they die faster. So the ones that have 2 or 3 days till expiration, and you trade those. Nothing wrong with it. They just don't. They hold on to their value a little bit stronger, so they don't die as fast going into the close. The closer, this shorter time frame, they die faster, so you get to collect your money faster. So you can just come in here, and all you do is you bid for it. It's mid of 277. Their bid. We're just gonna 277, 327. This is your buying one and you're selling one, but it's for a credit. So let's go down to whichever one's going to cost you more money. That's the 221. Ooh, that's a wide spread. Ooh, that's ugly. Look at how wide the spreads are on this thing. This is the stock market version. Man, look at the spreads. $80. Man, I don't want to trade this. Spreads are too wide, especially for day trading like this. You're going to pay a nasty spread, $100 in spread. 221. We haven't even got to it. Look at this. We got to go all the way down to 230. Well, we could probably get better than that in the real market. This is the demo. It's an $81 spread just to put this thing on. That sucks. Wow, spreads are wide. That's a lot of nervousness in there. But anyway, that's how you do it. The spreads are wide. You have to put $81 to get in, and probably $81 to get out. But you could put a limit order. say, I'm not going to pay you the $81, wait for the market to move to your position, but you're going to pay it one way or the other. Let's go look at silver. Let's look at silver and see what the spreads are on silver. Okay, so we got our long position on silver. We're going to close that because we're not going to hold on to it. We're going to go into our 2-minute chart. We're going to turn on our Fibonacci bars. Oh, it's already dropping like a crazy thing. Look at that thing coming down. So you wait for it to go up, 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 and away, and then you come in here and you just come in and very easy, 1 day till expiration, and you sell a call up here. And then you buy a call. You have to buy a call to protect yourself. It's just called a credit spread, okay, or a debit spread because you're paying. Oh, no, this is a credit spread because you're receiving. So the higher out your insurance policy is, you have to pay 63 and you're going to only receive 138 because this is silver, so it's not as big. And we're farther away from the market. You can come down here if you want. Now your margin is 450. Let's go to a margin of 500. Let's see what the spreads are. So you're going to receive $138. So you're going to receive 190 here and 54 there. And you're like, that's not enough money, man. I want to do more. Well, do 2 of them then. Do 2 of them. And now you make $280. That's not enough money. I want to make $500 a day. Oh, we'll just do more of them then. There's 4. There's $564. Do we need that? Let's go one more. We're going to do 3 of them. No, we need 4 of them to do $500. Okay, so now you got 4 of them on. You're going to make $564. You're going to have $2,000 that you have to have in your account to put this on. And then as long as the market stays below that red line and touches that purple line, the yellow line, where's it at? It's way out there. There it is. Okay, so that's the end of the day. So as long as it stays below that red line right there, you're going to make $564. It's like I said, it's a carnival game. It's not gambling. It's a carnival game. It's kind of gambling, but that's what a carnival game is. It's kind of gambling, but it's a carnival game. So the game is this little snaky thing here. You're going to go up to the booth in the carnival game, and you're going to say, okay, do you think the little snaky thing is going to stay below the red line? If you think it's going to stay below the red line, put your dollar right up here. You're going to put your $2,000 right up there. And if the little snaky thing in this situation stays below the red line, you're going to make $564. Got to hit that purple, got to hit that yellow line and stay underneath that red line. And you're going to make all your money. How much do I lose if I'm wrong? Well, if it goes up there, you can lose as much as $2,000. Whoo, that's a big bet. Well, that's only if it hits the purple line, it hits the gold line above the green line. That's where you lose $2,000. Okay. Down here, you don't lose 2,000. You lose a little bit shorter and less. Make money. And all you have to do is just hit the gold line, just 1 penny underneath that red line. You still make your full $564. You don't make any more. If it comes down here, you don't make more money because that's not the way this game works. It just has to be underneath the red line. Anywhere underneath the red line, then you get $564. And then anywhere between the red line and up to here, it's going to be a graduated scale. You're going to lose more. And then above the green line, now it doesn't matter how far above the green line it goes, 1 penny above the green line, you're going to lose $2,000. And then everything above there, and it's going to be less than 2,000 down through here, less, until you get down to 0 until it makes you money. Okay, so that's the scale. That's it. That's how it works. It's just a carnival game. But Land, what if I want to move the red line up farther, just in case it comes back up? Well, the market can come up like this, and then you'd be in a drawdown, but then it can end up down here, and you can still make your money. You come back up and come back down. That's okay. Nothing wrong with that. It's just got to end over here. But what if it goes back up and just doesn't go, just comes back up in there? And I think it's going to just kind of stay right there. Well, then do this. Just push this out here, up there, like that. Now you're going to make less money, right? And this has to probably be pushed out a little bit too. So now you're going to make $250 and you only need $1,800 in your account. We could make 2,000, but that would push this out and you'd make more money. So the smaller the insurance policy, Now we push that out. Now you have to have $2,200 and you're going to receive $292. But you can bring this in. See, now the market's got a bigger buffer. Now the name of the game is come up to this booth in the carnival game. And as long as the market stays below your red line, anywhere below the red line, you're going to make $276. Anywhere below the red line, $276. There you go. Play the game. I want to go further out, Lan. Okay, go further out. It doesn't matter how far out you go. I'm going to go way out here. As long as it stays below the red line, how much are you going to make there? $68. $68. Come up to the booth. As long as it stays below the red line, you're going to make $68. I want to make more money and have it still stay below that red line. We'll do more then. Go up here to 8 of them. Let's go up to 10 of them. You can go up to 10. You can go up to 100 if you want. It's all up to you. So you go up to 10. So now you got 10. Well, now you're going to make $170. You're going to risk $5,000. Right? If the market goes up to this green line, if it goes up here, anything above the green line, you're going to lose $5,000. Now, it's not going to lose any money below the red line. You're going to make money anywhere in here. Doesn't matter. Anywhere in there. It hits that gold line, anywhere underneath the red line, you're going to make $170. But if it goes up in here, well, now you're going to start losing money up in here. And anything above the green line, you're going to lose $5,000. But that's a long ways up. That's out there. Ooh, that's a long ways. And that's how far that market would have to go. And it's headed down. Well, it might turn around and go all the way up. You never know. So you just keep pushing it further and further away. Well, at some point, it doesn't make any money. I mean, at some point, it's not worth it. And you got spreads. The spreads aren't bad over here. Well, they're still probably a percentage-wise. So if we come in here, what's our spread going to be? So we'd have to put this on. Well, that's not bad. $40. You have to pay $40 out a year. So you're only going to make $150. Because it takes it out right there. So we're going to go up to 15. And you'd probably get 17 in the real market. You'd put it in the center. You put it midpoint and get 17. I'll bet they'd fill it for you. But here in the demo, they don't. They make you go right to 15. So we're going to take a full $30 on the spread. You place the order just like that. And there you go. That's your game. And you just let it. Now you can go out and do something. You can go, ride motorcycles or play your drums and your guitar, whatever you want to do. Because you don't have to do anything now. You've put the thing on there and the little snaky thing just has to do its thing. All right. That's it. That's gold and silver. That's how you trade it. That's how you can sleep at night. So you're not just going in and randomly buying some gold and randomly buying silver. You can play it like the carnival game. So you can, however you want. You want to play it for the long haul? Play it for the long haul. Go in there and buy some, put an option in there for 100 days. Just protect yourself for 100 days. Or you can come in and say, I'm just going to play it for today. And just sell an option up there and collect some premium while it stays below that level. Lots of different ways to skin the same cat so that you can sleep at night. And that's the whole name of the game, being able to sleep at night, right? All right, guys, we're going to take this same strategy. Now, next week, again, we're going to wrap up here. The next week, I'm going to be teaching down at the university. I'm going to be teaching the high yield investment funds. All right. So we're going to learn how to trade high yield ETFs. And if you can join me at the university, that would be great. And then what we're going to do is we're going to take basically some of these same concepts as a hedge. We're going to learn how to protect our big portfolio that's making all kinds of dividends. And we're going to combine it with options to help us protect it against losing premium. All right. So we're going to start learning how to do that. Options aren't a big deal. Don't be scared of them. They're just insurance policies. That's all they are. So we're gonna learn how to take advantage of insurance policies. And we're going to do that next week at the university. And then we're going to meet tomorrow. We're going to do a little day trading tomorrow. And it's going to be during power hour. It's not going to be during this morning session. Morning session's probably better for you to trade because the market moves more. Power hour, sometimes we get some trades, sometimes we don't. We're going to practice and use the software. We're going to see if we can make some money in it. But power hour, the reason I like to do power hour on here is because I don't want to trade it I want to save these times for trading myself. I don't want to trade power. I don't want to trade power hour. That's why I do my classes during power hour. All right, so we'll sacrifice a power hour to the class. We'll do it with demo, and I'll show you how to do it. Then you will play, and we'll play, and we'll play, and we'll show you how the software works, and then you guys can come and apply it to the real markets when there's probably better time to trade. And we'll show you when that is. All right. All right, that's all there is to it. We'll see you tomorrow afternoon at 1 o'clock my time. That's Mountain Standard Time. Make the adjustments for your time. And we'll do a little day trading. I'll show you how the software works and how it functions so you can do a little day trading. And if you want to put on some of these options, I would go get your track and trade software. Don't forget to get the track and trade software, and then you can do it just like I do it, where you can drag and drop them right on the screen. This is where I get the software.
Okay, this is the software I use. It's called Track and Trade. They've got two versions, one for stocks, one for futures. This is the website, track, the letter N, trade.com. This is where you download a free 2-week trial. No credit card required. Okay, go download your copy, then come back here, follow along, and I'll show you all my settings.
All right, that's all there is to it. Go get your software, load it up, and I will show you all my settings for day trading. We're going to do futures. So if you're going to do it, it's got two versions. So get the futures version.
Okay, this is the software I use. It's called Track and Trade. They've got two versions, one for stocks, one for futures. This is the...
All right, so get the futures version for day trading. And it does options too, but we're going to do day trading in the futures market because it's a lot better than trying to day trade the stock market. So we're going to do that, and then you can follow along, and I'll show you how to do it. All right, we'll trade the indexes tomorrow. Look at this market flush. Look at silvers. Came up real strong this morning. Had a nice big strong morning. Now it's all given back. What's it going to do? Probably go back to the delta cone of probability, isn't it? So if we come in from the beginning all the way to the top, it's coming right there. It is coming right back down into the delta cone of probability right there. Is it going to go down? This is where it'll probably stop. It'll probably come down, probably touch either 50 or 61.8, and then it'll start to go back up again, start doing maybe some of this stuff. Doesn't mean it can't come down further. It can. We got that 78.6 down there, right? Could come down here. But that's your delta cone of probability. That's why it's coming back down into there. Probability say it's going to come down there. All right, guys, I'll let you go. We will see you tomorrow, bright and early. Well, not bright and early. In the afternoon, 1 o'clock in the afternoon. No school this week at the university. See you then.
All right, that wraps it up for today. If you got something out of this, do me a favor. Like the video, subscribe to the channel, and share it with someone else who's trading or learning.
Hey, don't forget to tell them to subscribe to Pitt News Magazine.
Oh yeah, definitely subscribe to Pitt News Magazine. You'll thank us later.